Assalamualaikum and hi, my name is Natira binti Eridi.
Hi, my name is Nurul Fatih binti Azmi.
Hi, my name is Siti Shamira Atira binti Azmi.
Assalamualaikum and hi everyone. My name is Dr Umar. So today my team is and now we'll be discussing about financial analysis for the company 7-Eleven Malaysia Holdings Berhad for the year 2019 until 2021. I will pass this presentation to know Atira for a short story of company background.
Thank you, Amirin. 7-Eleven was founded by J.C. Thompson in 1927 and it was initially an ex-vendor of milk, bread and eggs to expand its business. The company then changed its name to 7-Eleven in 1946 and later changed its corporate name to 7-Eleven Incorporation in 1999. The first 7-Eleven store in Malaysia opened in 1984 in Jalan Bukit Bintang, Kuala Lumpur. Since then, the company has grown rapidly, operating in three segments which are convenience store, pharmaceutical and others. The main business is the retail sale of consumer goods including food and drink, mobile phone, touch and go, online games, bill payment and various convenience items. Since 2014, 7-Eleven Malaysia Holdings Berhad has been listed on the main market of Bursa Malaysia Security Berhad as a non-operating investment holding company. It is one of the largest convenience store chains in Malaysia with an intensive network of stores across the country. The company's strategic location, 24-hour running hours and broad product line contribute to its success. The goal of 7-Eleven Malaysia Holdings Berhad is to be the top convenience store, meeting the changing demand of the consumer for their convenience. With over 2,400 stores around the world, it has served over 1,900,000 customers daily. Next, I will pass this presentation to the Siti Shamira.
Thank you, Atira. Moving on to the vertical analysis. During COVID-19, 7-Eleven experienced a decline in gross profit from 2019 to 2021 due to inflation and rising inventory prices. The company's sales efficiency and ability to sustain activities declined as it struggles to manage finance costs and income tax effectively. Profit after tax decreased by 0.91% in 2020 due to income tax, administrative expenses, and finance costs. However, net profit recovered in 2021 by 0.71% due to reduced administrative costs. The company's financial position shows fluctuations in non-current asset and current assets, equity and liabilities over the past 3 years. The company's financial position saw fluctuations in non-current assets with a decline in 2021, possibly indicating a cautious approach during the pandemic. Current assets remained stable, but there was a slight increase in inventories. Equity and liabilities showed fluctuations with provisions and borrowings increasing in 2020 and 1.33% in 2021. Lease liabilities, trade payables and other payables showed a decline trend for 3 years due to contract liabilities increasing. Now, I will pass the presentation to Fatin for horizontal analysis.
Thank you, Shamira. Now I'm going to proceed with the interpretation of SOPLs. The company experienced revenue growth of 7.54% in 2020 and 18.95% in 2021, with cost of goods sold rising by 12.13% and 26.46% respectively. In 2021, gross margin increased by 2.51% due to the increased revenue and cost of goods sold. However, in 2020, the gross margin fell by 2.5% because of the decline in revenue of their convenience store segment during the COVID-19 pandemic. Other operating income rose by 17.53% and 20.81%, primarily due to the marketing revenue and convenience store sector. Administrative and operating costs increased by 32.59% in 2020 and 33.03% in 2021 as a result of impairment for underperforming store, impairment of an associate investment, increased staff costs, impairment loss on receivable, maintenance costs, and provision for restoration costs. Now, I will pass this presentation to Khairul Amirin.
Thank you, Fatin. I'm going to proceed with the interpretation of statement of financial position according to the horizontal analysis. For the non-current assets, increasing for every year from 100% in 2019 to 144.38% in 2022. 2022 and increased by 10.06% in 2021. The increases made due to 7-Eleven has been invested heavily in capital expenditure in recent years. According to current assets, the percentage of inventories and trade and other receivable and cash and bank balance will increase by each year. The slight increase in the percentage of trade and other receivable in 2021 might be 7-Eleven has been trouble collecting payments from its customers, which lead to an increase in trade receivable. In terms of equity and liability, the percentage of equity components have remained stable. In terms of liability, the percentage of borrowing and deferred tax liability constantly increased trend for 3 years. Meanwhile, provision and borrowing show an up and down trend for 3 years due to the economic environment, which also give an impact on companies' provision and borrowings. I will pass to Atira for the trend analysis of liquidity ratio.
Thank you, Amirin. Now, let's take a look at liquidity ratio. The table shows an increasing trend in liquidity ratio as the current, quick and cash ratio for 2019, 2022 and 2021 are below 1. This indicates that the company lacks sufficient cash and liquid asset to cover its short-term liabilities. Liquid asset can only cover RM1 ringgit liabilities up to 55 cents, 63 cents and 81 cents for 3 years, while liquid ratio can only cover 23 cents, 31 cents and 36 cents each year. Meanwhile, cash ratio can only cover up to 90 cents, 50 cents and 30 cents for each current liability. This high risk for short-term commitment is a concern for 7-Eleven. The working capital trend showed an increasing trend from 2019 to 2021, but it still shows negative outcome due to higher debts, potentially causing the company to struggle with growth or credit repayment, and it will potentially lead to bankruptcy. Next, I will pass it to Shamira.
Thank you, Atira. Moving on to the analysis of leverage ratio. The company's debt ratio for 2019, 2020 and 2021 are 92.82%, 92.08% and 91.95% respectively. These ratios indicate a high reliance on debt which could lead to insolvency. The debt to equity ratios for 2021 until 2019 are 11.43, 11.63 and 12.93 respectively. The times interest earned has fluctuated over the years, decreasing 2.76 times in 2019 to 2.15 in 2020. The debt to tangible net worth ratio decreased from 18.15 in 2019 to negative 7.10 in 2020 and negative 7.01 in 2021, indicating a negative net worth and potential financial risk. The current debt net worth ratios are 7.25, 5.60 and 4.67, indicating a declining level of current debt relative to net worth. This suggests improved financial stability and stronger ability to meet short-term obligations. Now I will pass the presentation back to Atira for efficiency analysis ratio.
Thank you, Shamira, for the great explanation. Now, let's move to the efficiency ratio. The table reveals an increase in the average collection period for the company with an average of 30 days in 2019. However, due to COVID-19 in 2020 and 2021, debtors took longer to pay their debts, indicating inefficient collection of accounts receivable. The company average account collection is 11.73, but collection time decreased to 11.37 and 9.83 times. The average debtor collection period is 31 days in 2019 and 2020, while in 2021 it required 32 days. The company cash flow is good, but it struggled with inventory management. 7-Eleven made 52 days to sell all its inventory in 2019 and 58 and 68 days in 2020 and 2021 respectively. Additionally, the company was not allowed to open store 24 hours during the COVID-19 outbreak, resulting to excessive inventory and insufficient inventory replacement. Next, I will pass to Khairul Amirin.
Thank you, Atira. Now we look into the profitability ratio. At my right side is table of calculation for the gross profit margin, net profit margin, total asset turnover, return on asset and also return on ROA. For the gross profit margin and net profit margin, both are relatively constant, which indicates stable and low risk. Even there is a tendency problem in declining, but the percentage loss is not significant. Total asset turnover has decreased significantly from 2.17 times in 2019 to 1.47 times in 2022, continuously decreasing in year 2021. It shows that 7-Eleven is inefficient in generating revenue from its assets. Result, return on asset showed the group's inability to use its asset to create profit for year 2019 to 2021. However, in year 2021, ROE has increased 3%, which leads to improvement to the company to efficiently utilize the asset to boost sales. While for DuPont ROA for year 2019 and 2021, each indicate 4% of ROA and 3% of ROA respectively, were both contributed by lower sales for invested and less profitability level. However, in 2022, indicate 1% of ROA, which contributed by lower profitability level by average asset utilization. I would like to mention to this suggestion of 7-Eleven to improve profitability. The first one is to increase the price, reduce the cost, and also focus on high margin products. I will pass to Fatin for further explanation of market strength.
Thank you, Amirin. Now let's proceed with the market strength and evaluation. First, earning per share. This ratio indicates the profit earned per unit of issued share. 7-Eleven shareholders are getting 4.74 cents, 2.60 cents and 3.93 cents each share held in the company for 2019, 2020 and 2021 respectively. In 2019, it's the high value of 4.74 cents. It indicates a high profit per share, and this will be preferred by the existing shareholder as well as the potential investors. Second, price to earning ratio. The higher PE ratio is 52.30 times in 2020, indicating that investors have higher expectations for future growth and are willing to pay a premium for the stock. Conversely, the lower PE ratio of 30.17 times in 2019 suggests a lower growth expectation or potential undervaluation. Third, dividend per share. The amount of dividend received by ordinary shareholders declined over the year. The company is paying the higher dividend per share to its existing ordinary shareholders in 2019 of 2.4 cents compared to 2020 and 2021, that is 2.3 cents and 1.6 cents only. Next, dividend yield. Dividend yield for 7-Eleven for 3 years has slowly decreased from 1.38% in 2019, 1.69% in 2020 to 1.07% in 2021. The slightly different in the percentage of 3 years because of the company had to cut its dividend due to the decline sales or profit. Last one is dividend payout ratio. Dividend payout ratio for 2019, 2020 and 2021 is 51%, 88% and 41%. The higher payout ratio, which is in 2020, indicates that a larger portion of earnings is being paid out as dividend, while the lower payout ratio, which is in 2021, suggests that the company retained a larger portion of its earnings for the other purpose such as reinvestment or debt reduction.
Thank you once again, Fatin, for the great explanation. I would like to continue on admin Z-score. Right on my side, shown a table of admin Z-score with the formula of calculation. In 2019, 7-Eleven admin Z-score was 3.7114, which considered a safe zone. However, the COVID-19 pandemic has significant impact on the company's financial health, and its Z-score dropped to 2.5611 in 2022. The company's Z-score increased to 2.7394 in 2021, which suggests that it took appropriate action to improve its financial health. I would like to pass to Shamira.
Thank you, Amirin. Next is cash flow analysis. The company's operating cash flow to current maturity of debt for 2019 was 2.5 times higher than in 2020, indicating a better ability to meet debt obligations. In 2020, the ratio increased to 3.11 times, indicating improvement in generating sufficient cash flow to meet debt obligations. The 2020 ratio was 41.18%, slightly lower than 2020, but significantly higher than 2019 at 207.44%. The operating cash flow per share was 0.27 cents in 2019, and the ratio to cash dividend was 14.63 in 2021. Slightly higher than the previous 2 years. Now I will pass the presentation to Fatin for qualitative analysis.
Thank you, Shamira. Now I will continue with SWOT analysis. First, strength. 7-Eleven's strength includes strong brand recognition, diverse product offerings, a strong franchise network, and an extensive store network. The company's well-established brand value and reputation attracts customers, while its diverse product offering cater to various client segments. The company collaborates closely with franchises to ensure quality and customer service, providing support and training. Second is weaknesses. 7-Eleven faced weaknesses in its limited store format, dependent on third-party suppliers, limited market penetration, and competition from other retailers like convenience store, grocery store, and online retailers. This factor limits its ability to offer a wide variety of products and services, potentially causing supply chain disruption and quality control issues. Third, opportunity. 7-Eleven can capitalize on the growing convenience store market by expanding its presence and increasing market share, diversifying product offerings such as healthier and fresh food, and partnering with retailers like Postmate and DoorDash can help meet customer preference. Additionally, partnership with delivery company can expand delivery options. Lastly is threat. 7-Eleven faced threats from intense competition, changing customer preference, regulatory environment, and negative publicity. The industry's competitive nature may impact market share and profitability. The rise of internet shopping and delivery services may also challenge the traditional convenience store model. Additionally, challenges from food safety, labor law, and environmental issues may impact 7-Eleven's operation and expenses. Okay, that's all from me, and I will pass the presentation to Atira for conclusion.
Thank you, Nurul Fateh. Moving on to the conclusion. 7-Eleven in Malaysia holders' Berhad performance has declined due to COVID-19, resulting in lower profits and decreased sales. The company liquidity ratio is below 1, indicating insufficient cash flow to pay off debts. To maintain cash stability, 7-Eleven may need to restructure loans or explore restructuring loans with bank and creditors. The company profitability ratio are also declining, and liquidity difficulty may arise due to decreased efficiency. The company Almanzat score analysis indicate that the company is in a safe zone, but immediate action is needed to improve sales and manage costs. From the financial statement and analysis conduct, we find a few weaknesses like limited store format, dependent on supplier, market penetration, and competition. Therefore, to maintain its competitive advantage, 7-Eleven must expand its presence, diversify product offerings, and partners with delivery companies. That's all from us. Thank you.